Today you will learn a new topic, that is accounting for stock movements. First, we will try to understand what is meant by stock. Stock and inventory, in some books it says stocks, and other books inventory. And also the accountants some accountants say stock and others say inventory, but it is the same thing. Stock or inventory refers to the goods for resale, work in progress, and raw materials that are held at a given point of time within the business. So it is normally expressed as stock on hand on a particular date. Say if it is end of the year, say 31st December 2011, 2012 or 2007, or depending on the accounting year. And the stock valuation means assigning a monetary value to unsold stocks. That is called stock valuation. First thing is to stock take, and then assigned monetary values, and then finally you can value the stock available within the business. The relevant IAS, International Accounting Standard, applicable to stock valuation is the IAS 2. The title of the standard is inventories. In terms of this standard, IAS 2, inventories shall be measured at the lower of cost or net realizable value. So that is a requirement, and all the accountants are required to comply this requirement. And also the cost of inventories shall comprise all cost of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and present condition. Purchase price, you know what it is. When you purchase goods, the purchase price is there in the invoice. Sometimes some goods are to be change the status of the goods, because we cannot sell the goods as it is. Sometimes if it is vegetables, or you have to clean them, and if you purchase in bulk, and then you have to put them into small quantities and repack them. So these are called conversion. And other costs incurred like insurance, warehouse charges, transport, other costs incurred in bringing the inventories to the present location and condition. So all these are included in the cost of inventories. Assets held for sale in the ordinary course of business is called inventory. Then again, depending on the nature of the business, we have to determine whether it is inventory or a non-current asset. That is one item, and the other one is assets in the progress of production. That means incomplete items within the production process, within the factory, is called work in progress. Work in progress also part of the inventory. And you have raw materials in your warehouse, in your factory. So if it is say manufacturing business, raw materials also part of the inventory. Then inventory sometimes consists of unsold items, in the normal course of business, and work in progress and raw materials. The accounting for stock movements, this is the most important thing that we are going to learn. Stock movement means issues from the warehouse and also purchases from the suppliers. Purchases are recorded at cost price, and for that purpose we use cost formulas. The cost formulas cited in the accounting literature include first in first out method, the shortened form is FIFO, and last in first out, LIFO method, average cost method, standard cost method, but the International Accounting Standard recommends 3 cost formulas. One is first in first out, and the other one is weighted average method, and third one is specific identification method. So these are the recommended methods, but that in textbooks you will find number of methods, that is for academic purposes, and these 3 are for practical purposes. The stock on hand is valued using the same cost formula, and which is used for issues. So these cost formulas are used for issue of inventories. So then same formula is used for the valuation of unsold stock or stock on hand as well. Then finally, since we use the cost to value the issues, so then total of issues represent the cost of goods sold. Cost of goods sold. FIFO method, that is a recommended method. This method requires that the cost of items purchased first be assigned to the cost of goods sold first. This method assumes that the cost of earliest inventories acquired are the first to be recognized as the cost of goods sold. In other words, in the stores there may be several layers of goods purchased at different times. So then first stock that were taken in, there must be a cost. So the first in will be issued first. Then the cost assigned to first or old stock will be used to value the issues under this method. In other words, issues are recorded at historic cost, because for issues you use the old price. The balance stock, the stock unsold, is therefore valued at recent price. So that is the significant feature of first in first out method. Issues are recorded at historical cost, and the stock unsold is valued at recent price. Under LIFO method, although it is not a recommended method, but for academic purposes it is useful. This method assumes that the cost of the goods purchased last, that means in the recent purchase, is charged to the cost of goods sold first. And it assumes that the cost of latest inventories acquired are the first to be recognized as cost of goods sold. Then, as a result of this, cost of goods sold is valued at recent prices or the recent cost, and stock is valued at historical cost. So there are significant differences between LIFO method and the FIFO method. The weighted average method, it provides the average unit cost. That's why it is called weighted average method. So cost is always the average cost, average unit cost. Average unit cost included in the cost of goods sold. Therefore, stock is valued at average cost. Issues are also valued at average cost. Then these points are important. When a business entity select a method or the cost formula, that should be used continuously. This is according to the consistency principle. So if you use one method, so then you have to continue to use the same method. And the other important thing, but it is not very important for sole proprietorships and the partnership, but it is for companies, it is very important. The cost formula used and also the basis for valuation should be disclosed in financial statements. And also it is important to note that if you use different cost formulas, the gross profit may vary because the cost of goods sold is different. There are inventory methods, two inventory methods. One is called periodic inventory method and the other one is called perpetual inventory method. The cost formulas that I have mentioned earlier are applicable to these two inventory methods. The periodic inventory system, under this method, inventory account is not updated immediately after change of inventories. Change means issues or purchases. Inventory account is updated after the stock take. Stock take is normally carried out at the end of the year or in the middle of the year. Under this method, under periodic system, no cost of goods sold account is maintained in the ledger. Instead, in the ledger there are several accounts like purchases returns, and also the inventory account. If you want to calculate cost of goods sold, so then you will have to use these accounts as we have already done when you are preparing your financial statements. All these explanations that were done for financial statements, it is under periodic system. Under perpetual system, inventory account is continuously updated. When there is a change in inventory, so then it is updated immediately after a change. Under this method, there is no purchases account. All inventory movements are recorded in the cost of goods sold accounts. So therefore, it is very useful, and this system provides information for the preparation of periodic financial statements. Periodic financial statements means quarterly financial statements, half-yearly financial statements. These are called periodic financial statements, and periodic financial statements, of course, applicable to large businesses. But in this class, we still learn small sole proprietorships, but it is better to know that there are two inventory systems, and the perpetual inventory system is the most accurate and update system. Now we will work out an inventory card or stock card. For that, turn to illustration 18.1. Inventory card is the record card kept for each and every inventory item or stock item. This card records the items purchased and also changes like issues, and then finally the balance. So as you can see, this is the format for a stock card. Stock item is mentioned here. In this case it is DVD players, and there must be a code number for each and every stock item. It must be included. I left it blank. And the valuation method also included here, because that gives you the indication that how to value this stock, issues and the closing balance. So these are the basic information. There may be some more items, more information, but I included only the basic information. And then date column, reference column. The reference column shows the document reference. For the stock movements, the two documents or source documents used are invoices and the goods receipts notes. The shortened form for goods receipts note is the GRN. Invoice is used for sale to record sales or issues, and GRN is used to record purchases or the goods received. And all the receipts are recorded in the in column or either in column or receipt column same, and the out column or issues column again same. In some stock cards, some businesses use receipts instead of in, and some businesses use out or issues. And final column is to show the balance available. You received some amounts of goods, and then you issued some amounts of goods, and finally there must be a stock in the warehouse. The balance shows the stock on hand. So now you can turn to illustration 18.1. You are given the details of purchases and sales of DVD players relating to a sole trader. So then we can make entries in the inventory card using first in first out method. So if you want, I can put some number. 4572 is the code number, although not given in the question. Just for completion purpose, I just put this. 2010 1st January, inventory on hand. Inventory on hand means the balance brought forward. It is recorded in the balance column. 25 units, cost 100 per unit, therefore the value is 2500. On 4th, 1 1 January, the business has purchased 10 units. Then GRN number 210 is the reference. Received 10 units at 120 kina each. Therefore, 1200 is the value of purchases. No issues on that particular day. So then now, today is 4th. After this transaction, the business has 2 layers of stock. One is 25, that was purchased, that was the opening balance, and today we purchased 10. So business has now 35 units. 35 units. 35 units. Enter them separately. So then we can, it is easy to assign the cost. 25 units are valued at 100 kina, and ten valued at 120. Therefore, 2 different values. 2500 old stock and current stock 1200. Total it works out to 3700. So this gives us the composition of stock and also the corresponding prices. Then move on. On 10th, the business has sold 20 units, invoice number 60. Invoice number 60, record it in the out column. 20 units, 20 units, and we don't have to use any other price other than the prices recorded in the balance column. This is first in first out method, and this 20 is issued out of this 25, that is the old stock. That is the old stock. There are 2 layers, and if it is first in first out, take 20 out of 25 and assign the price or the cost. Then 2000 kina. Now balance. We had 25, out of 25 we issued 20. Now 5 left. And we haven't touched the recent stock, 10 units. It remains unchanged. Therefore, the stock is 15. We had 35, issued 20, and 15 left unsold. So 5 units, still we have 5 units at old price, 120 new price. Then the corresponding values are 500 and 1200. And the total is 1700. So this is the value of the stock. Then on the 12th, what happened? Purchased. Purchase means GRN 211, number of items purchased 20 at 110, a different price, 2200 is the value. Now the stock. stock consists of 5 units still unsold, 10 units the second stock, third stock 20, and total stock 35, right, because we had 15 units, 15 DVD players, and we purchased another 20, now 35, but the breakdown is important. Okay, 5 at 100, 10 at 120, 20 at 2200, sorry, 110, then the values are 500, 1200 and 2200, $3,900. Then on the 18th sold, sold, then invoice number 61, issues are recorded in the out column. How many units sold? 12 units. So then look at the composition of the stock. This is first in first out, first old stock first, then 5 from the old stock, and we have to have another 7 units to make it 12. Make it 12. Okay. 5 units, first in first out price 100, and this is 120, then 500 plus 840, 500 plus 840, $1,340. So that is the cost of items issued. Now we had this stock, and these are the changes. Now find the closing stock. 5 issued, 7 issued out of 10, then 3 remain unsold, 20 not sold, and total 23, unsold stock. Then 3 out of 10, therefore old stock 120, and 20 at 110, 360, and 2200, total 2,560. That is the value. On 22nd, purchase 30 units, GRN number 212 30 units at 125, then the value is 3750. Now move on to the stock column or the balance column. 3 units unsold, 20 units unsold, and the new stock is added. Then the total stock 53, and now assign the prices or the costs. 3 at 120, 20 at 110, 30 at 125, and then the corresponding values 360, 2200 and 3750. Then find the total. Total works out to 6310. Then the last item 28, sold 40 items. Then you cannot just enter 40 here. We will have to look at the stock composition. First in, first out. The old stock 3, next old 20, 23, and we need another 17 to make it 40. 17 out of 30. Then total 40 here, and the issue prices. Issue prices are 120, 110 and 125. The values are 360, 2200 and 2125. Total 4685. Now check the closing stock. 3 gone, 20 gone, 17 out of 30 gone. So then balance is 13. At what price? 125, and the value is 1625. So this is the inventory card. Inventory card. It clearly shows the value of stock and the cost of goods sold. Cost of goods sold or issued. So 28 is the last day of transactions. So then on that date or the end of January, stock on hand is 13 and the value of stock is 1625. If you want to find the cost of goods sold, find the total of the value column. Value column. Value column 2000, 2000, 1340 and 4685. These are the value of stock, value of issues. So then if you want to know the cost of goods sold, this is the amount, 8,025. 8,025 is the cost of goods sold or the value of issues, and this is the value of stock. Now let's look at the weighted average method. This is weighted average method. Then we turn to illustration 18.2, where you have been asked to prepare inventory card using weighted average method, but using the information given in illustration 18.1. So then we use the same information. First, balance. Balance on this date, 25 units at 100 kina, 2,500. On 4th, purchased GRN 210, 120 kina, 1,200. Now the stock consists of 25 plus 10. It is 35. Then, since it is average method, we will have to find the values. How do we find the values? We have 2,500 plus 1,200. It works out to 3,700. That is the total value of the stock now. And we have 35 units. If it is 35 units, then the average price per unit is 105 kina 71 toya. So that's how you have to work out the average price, average cost or weighted average cost. So then here 105 kina 71, 3,700. Even if you add 2,500 and 1,200, you get the same total. Invoice 60 on 10th January, sold 20 units. Now use the average cost. It is given here, 105, very easy, 71, 20 at 105, 71 means 2,114. 35 minus 20 is 15, valued at 105, 71, then you will get 1,586. Next, 12th, GRN 211 20 units purchased at 110, value 2200. This is similar to earlier records. Now the value of the stock we will have to work out, but first we can enter the number of units. We had 15 plus another 20, that is now we have 35. Then again we have to work out 1586 plus 2200 works out to 3786 divided by 35 gives us 110.17. That is the price to be, or the value to be, cost to be used for calculation of closing stock. Then how much is it? 3786. 18th invoice 61 issues 12 units issued. The price is given here 108.17 Toya. Then the total 1298. 35 minus 12 is 23. Same price 108.17 Toya. 2488. 22nd GRN GRN 220. Amount received or purchased 30 at 125. Total 3750. Now 23 plus 30, 53. Find the average cost. How can we do it? 2488 plus 3750 equals 6238 and quantity 53. Therefore average cost is 117.70. 117.70. 6238. Last item 28 invoice number 62 issued 40 units, same price 117.70 and value 4708. 53 minus 40 is 13. Stock on hand 13 at 117.70. Then the value of the stock on hand is 1530. So average price is calculated when there is a change, and that average price will be used for stock valuation and also the issues, for issues. to find the cost of goods sold. So then if you want to find the cost of goods sold in this question, yes, at these figures 2114, 1298, 4708, then total is 8120. And first in first out method, it was 8025, now it is 8120, different values. And here the stock on hand 1625 under Fifo method, but under weighted average method it is 1530. So there are different values. That's why I said earlier the standard says use the same method throughout if you are using or have chosen one particular method. Okay, that's the end of the lecture.